The bull market is back, and greed is good. That's coming up on 3 Minutes on Markets and Money. Yesterday, Jerome Powell gave a speech implying that he's worried about over-tightening. Now, this was a very different statement from Jerome Powell from what we saw just about a month ago when he said he wasn't worried about over-tightening because they had tools to solve that problem. Now, all of a sudden, as employment started to show some signs of weakness, manufacturing index is declining, now he's worried about over-tightening. Well, the bulls took their cue yesterday, rallying the markets 3.1% on the S&P. Now, just to put that into perspective, we rallied 5.5% following the CPI report earlier this month. So again, here are the bulls again charging into the markets on expectations the Fed is about to stop hiking rates and tightening their balance sheet. But that's not what Jerome Powell said. He said, hey, we're going to slow the pace of rate hikes, but may need to even hike even more next year. In other words, raising that potential for the terminal rate to over 5%. Markets ignored that point, said, hey, don't worry about that. Slower pace of rate hikes. That means buy stocks, right? Well, here we go again. Markets rallied very nicely yesterday, coming right off support of this 20-day, 100-day moving average crossover. That actually occurred yesterday. Now, the good news is this rally, as we discussed yesterday, kept that MACD sell signal from triggering. So we now still have a MACD buy signal in place. Markets are getting a little bit overbought here, but markets got above that very important 200-day moving average. So here we've broken above the 200-day moving average. That means the bull market is back. Maybe not just yet. We did this back in March, by the way. We actually got above the 200-day moving average by 3%, and then the markets rolled over and broke back down below the moving average as the Fed was still hiking rates, as they were starting to talk about quantitative tightening, etc. Is this time different? Possibly. But as we move into the end of the year, as we've talked about previously, the market is going to be looking at end of the year window dressing. We've got the first 5 days of January, lots of monetary inflows. So there is a potential here. The markets could rally a bit more, but our target has been 4,000 to 4,100. We're knocking on that door right now. At 4,100, we're starting to challenge kind of these previous resistance levels, and up to 4,200, we're really kind of talking about a lot of resistance in this market over the next couple of weeks as the markets try to move higher. A series of resistance levels the market's going to run into. And again, with the markets already overbought, it's a little bit late to be chasing the markets here. So be careful running after the markets. Doesn't mean there's not a little bit more upside here, but that upside is getting pretty limited at the moment. So whatever trades you make sure and keep tight stop losses on it. We may trade this market as well depending on what happens. But what we need to see here is a successful retest of that 200-day moving average breakout. We don't have that yet. If the market reverses, goes back lower, this could all be behind us very quickly. So just be cautious. While greed is good, that doesn't necessarily mean that risk is off the table. That's 3 Minutes on Markets and Money. See you back here tomorrow. The bull market is back. Question mark? No.
The bull market is back?
Are back.